What up? What up? Antonio in the house, and this is
Trent LeDuc with Elite Mortgage. What's going on, everyone?
Let's Go, baby. Today we're going to touch on biggest mistakes we see buyers make, whether it be in the beginning of the process, middle of the process, and even end of the process. I'm going to have Trent open it up here for
Yeah.
us.
So on the mortgage side of things, I think one of the biggest mistakes is pulling a line of credit while we're in the middle of processing or underwriting a loan, or even right before we go
Hey,
to process.
Trent, what is underwriting, and what is that?
So it's basically when the lender, the bank, they go through all your documents. They're looking at any tax, anything you have in the background. They're literally going through your whole entire file to make sure everything's clean. Going through the property documents to make sure they're pulling insurance, all kinds of stuff behind the scenes, and basically making sure you're sound to actually buy the property, and they're going to lend you the money. But that's how processing and underwriting usually works. There's a little bit more to it, but kind of a little bit of a breakdown.
Cool.
And pulling a line of credit. Breakdown here again too is opening up a new credit card, getting that new car, you're getting a new loan, any kind of loan or anything like that, you're opening a line of credit, which affects your DTI, which goes on your credit report.
What's DTI?
DTI, great question, Antonio. DTI is debt to income, so it's your debt to your income. So let's just use even numbers here. If you're making $10,000 a year and you have $5,000, $10,000 a month, sorry, and you have $5,000 a month in debt, that's 50% DTI because you're using 50% of your income for expenses, right? So that's a little bit of a breakdown of what DTI is. But when you open another line of credit, that then bumps your DTI because now you have more debt, right? So if you open a line of credit, that's how you blow up a deal. Do not do that.
So again, breaking down kind of what he was saying just there is like, I think a lot of people are like, oh, we're under contract. Now I'm good. Now I can go buy a couch set. I can go buy an AMG. I could go buy a private jet for what it matters. And it's like, no, not the case. Oftentimes, when he's running numbers and stuff, it's like, all right, well, max for this loan, we're going Fannie Mac and we're doing 5% conventional loan. We can't have the debt to income be more than 45% or whatever the percentage.
Yeah.
I don't know what it is.
It depends on the loan type and stuff like that. That's a whole different
whole
conversation.
different ball game. But okay, then you go out and take a loan on something, right? And instead of your debt to income with this loan being 40%, you just made it 46%. Now you can't get approved for this loan anymore.
Even so some people are right on the teeter I've worked with before. So if you go conventional, usually you want to stay under 50% DTI, for example. Conventional is just a loan type for everyone that doesn't know what it is out there. But I've had people be running the teeter of like 48, 49%. And if you pull a line of credit or something like that, even if you go up that 1 or 2%, you can blow up the whole entire deal. Don't go buying, like Antonio said, no cars, no furniture. Paying off other credit cards with a different kind of loan. I had actually had that happen to me a couple weeks ago, but I saved the deal because it was a different loan type than conventional. But yeah, don't do any of that. You're gonna give me a heart attack.
Yeah, for sure. So for me, I think a lot of it is a little bit different. It's more mental stuff. He kind of deals with the actuality stuff of like, hey, dude, we know you just bought an AMG. We can see it on your credit pull. Like there's no going around this. It's like this happened.
Yeah.
Most of the time, for me, it's actually about setting up the right expectations. So really, I like to say if my clients are doing something wrong or don't understand something, it's probably reflecting back on the realtor. So most of the time, when I have this conversation with my clients, I go, listen, you talk to my lender, right? We're going to go over what you can actually afford. What you want and what you can afford generally tend to be, unless you're doing really, really well, a different thing. Right, so say in your head you're picturing a $700,000 house, but on paper you can only really afford a $400,000 house. My point to you is going to be, hey, we're going to look for $350,000 houses, and then that gives us some leverage and leeway here to maybe go up to 400 if we really like the house.
100%.
So it's about setting expectations, and I think a lot of buyers too, especially first-time home buyers, they have this expectation in their head that they deserve this beautiful house fresh out the gate. It's like, no, most of your parents bought this house that was not that. It wasn't the $1 million mansion on the side of the lake. It was the little shitty house that is the ugliest one on the block, and they bought it and they fixed it up and they rented it, or they either sold it or rented it, took that equity and then bought a nicer house. And that's really how you get into the game, because it's like everybody thinks they can just go get the bike and then just ride it. It's like, no, that's not how it works, man. If you're going to fall down a couple times, you got to get used to what the bike, how to ride the bike. You get used to it before you take it on the highway. And I think that's a big thing I see where we see like just people, they have these expectations that are unreasonable for where they are in life.
Yeah. And unfortunately, like he said, it's not like what it was back in the day. Like house prices are way different than what they were back then. So yeah, you can't, like exactly what he said. You can't go buying the bike expecting to ride it right away. There's gonna be some hiccups in the road. You gotta like start low sometimes, and that's just the way it is.
Yeah, for sure. What other piece of advice would you say from the finance side?
Finance side, huge one right here. This is just a life lesson in general, but it just plays hugely into the mortgage industry. You get nothing by lying to me, and when I say that,
Why?
because this AMG man over here, if you lie, I can't help you. So if you're saying, for instance, we'll use a line of credit. If you're pulling a line of credit and you're just, oh yeah, we're not going to do anything, and you know you're going to pull a line of credit, I can't do anything to help you if you're lying to me. Or you have, before we do go on the hard credit report, right? And you're saying, oh no, we have an 800 credit score, and we're using that for basic numbers. I'm telling you, basic numbers what you might get approved for. Obviously not a said pre-approval, but. And then we go to pull your credit, and you come back at a 650, and you're mad at me because you're not approved for what we thought you were going to be approved for, because you lied. So you get nothing by lying to me because I can't help you.
What's that saying? You can bring a horse to water, but you can't make him drink
it. That's right.
That's right. At the end of the day, for sure, that's a good one.
Do you see that a lot on the realtor side of things?
Yeah. Oh yeah, man, all the time. So I would say like my job, like. Why do I get paid? It's like, why the hell would you pay me 6% or 3% or 2% or whatever the buyer agency or seller agency is? It's like, most of the time it's I'm dealing with your bullshit. You know what I mean? Like, I am quite literally a therapist, a numbers guy, a real estate guy. It is more than just the deal. If it was just a deal, you probably wouldn't need a realtor. I'm going to be honest with you. Probably not. You could maybe figure it out. I still think it's probably a better idea to have a realtor. But I think there's a lot of emotions that are going on in the deal, and I think that is another big piece is like the difference between really successful investors that are worth a lot of money and guys that can barely afford the first house is emotional intelligence. It's EQ. It's being able to logistically go over a deal and go, hey, can I afford this? Is this a good deal? Should I move forward? And then not lying to your loan officer and being like, well, I got this, and that, and then it turns out you don't. You know what I mean? Mm-hmm. So I think at the end of the day, it's being transparent. And a lot of what I do as a realtor is kind of like what I like to call is just peeling the onion. It's like you might tell me, oh yeah, my credit score is 700, right? And that's it was 700 2 years ago.
Yeah.
Diane, it's 400 now.
Yeah.
So and we're gonna have to go from there.
100%.
And so I think like we see that more. Where they put up shields, you'll put up shields, and like it doesn't help anyone. But I get it because it's an emotional thing. It's like, well, I don't know if we really want the house anymore because of the roof. I go, okay, well if it's the roof, let's go back and we'll ask for a $20,000 concession.
Yep.
And you don't need to worry about it. How about that? And it's like, well, no, we really. Okay, so it's not the roof.
Yeah.
You know what I mean? I think that's the big thing is, hey, be honest with us. As your realtor and your loan officer, we're trying to look out for you and making sure you are making the right decision. And we can only, we can kind of do a little bit of brain reading, but we can only do so much.
Yeah, 100%. I think that's one of the most massively overlooked things in the industry is just be honest with your, the people you're working with, the realtor and the LO, because we can only help you. We can't harm you. I mean, yeah, unless you have a bad one. But
that's why it's so crucial to work with a good one. That's kind of why we're here making these videos for you, like show you, hey, like life is like, I kind of want you to understand too what goes on in the back end, so you know what's going on when you are buying, so you have a little bit of head knowledge of what's going on and what the process is like.
Yeah.
But
you want to make sure you have strong people. There's like a bunch of people working on a real estate transaction. You have title. You have, lawyers if you're in Massachusetts or attorneys. But if you're in New Hampshire, you don't have the attorney part. But you have the lender, you have the LO,
insurance,
you have the real estate agent, the buyer side or
TCs,
seller side, insurance. Yeah, there's a million people. You want to make sure you have strong people that can communicate and work good together. You know what I mean?
Yeah, for sure. And I think we'll probably end it on that. We'll try to make this video too long. So I appreciate you guys tuning in here, and we'll have another one out for you in a jiffy.
I'll see you guys soon.
Peace.